All right, so we're diving into the SEC case against Ripple this time. Unpacking this whole thing, the July ruling, the appeal.
It's a big one.
Yeah, you sent over this article by John Reed Stark, former SEC lawyer.
Right.
And wow, he does not hold back. Calls the initial decision troubling, even going as far as saying it undermines the SEC's entire mission.
Yeah. And that mission really boils down to protecting investors, right? So essentially, we're trying to figure out if XRP should be considered an investment contract, even when it's in the hands of everyday buyers.
Okay, so we're talking about the Howey test then, right?
Exactly. The SEC is really leaning on the Howey test here to make their case.
Right, the Howey test. But how does a rule from like 1946 even apply to something as new and complex as cryptocurrency?
Well, that's the million-dollar question, isn't it?
Hmm.
The SEC's argument is that those core principles of the Howey test, they still apply. Think about it. The whole reason the Howey test came about was because back in the day, you had these companies selling shady investments, leaving everyday people out to dry.
Taking them for a ride?
Exactly. And the SEC sees some parallels in the crypto world today. They're worried that history is repeating itself just with digital assets instead of paper stocks this time around.
So how does the Howey test actually fit into the Ripple case specifically?
So Judge Torres, the one who oversaw the initial case, she essentially said there were two ripples.
It's two ripples.
Right, two different ways to look at it. You had the institutional investors buying XRP directly from Ripple. For them, it probably looked a lot like a security. They understood the risks were looking for profits tied to Ripple's efforts.
Makes sense.
But then you have the average person just buying some XRP on an exchange. Judge Torres ruled differently for them. She said the Howey test didn't really apply in those cases.
Hold on. So the same exact token can be a security for one person but not for another. How does that even work?
That's exactly what has people like John Reed Stark so concerned. See, Judge Torres argued that people buying XRP on exchanges, they weren't necessarily aware they were buying it from Ripple directly.
Okay, but they're still buying XRP.
Right. But she basically said those buyers on the exchanges, they weren't relying on Ripple's efforts to increase the value of XRP, at least not in the same way as those institutional investors who bought directly.
But isn't that creating a loophole? I mean, companies could just funnel their tokens through exchanges, knowing that those buyers might not be as financially savvy?
And that's what has Stark so fired up. He, along with a lot of legal scholars, would argue that just because an investor might not be as informed doesn't mean companies should get a free pass. It gets to the heart of what securities laws are designed to do: protect everyone, not just the Wall Street experts.
So it's less about the technology itself and more about this principle of investor protection.
Exactly. And it raises this fundamental question: can a law written for paper stocks back in the 1940s really capture the complexities of a token that you can buy with one click on an exchange?
It's a whole new world.
It is.
Stark's article dives into other cases, too, even contrasting rulings from different judges. Is the legal world as divided on this as it seems?
It's definitely messy. Let's look at the Terraform Labs case. Judge Rakoff was the judge on that one, and he's pretty much a legend when it comes to securities law. And he completely rejected this whole idea that the trading venue makes a difference. He basically said a security is a security. It doesn't matter if you're buying it directly from the company or on some exchange. If a company is out there promoting their token, talking up its potential, anyone buying it has a reasonable expectation of profit based on the company's work.
Okay, but that seems like a totally different take than Judge Torres's. One judge says the trading venue matters, the other says it doesn't. So where does that leave us? What's the bigger picture here?
I think what we're seeing is a legal system that's trying to catch up with a technological revolution. The Ripple case isn't just about Ripple. It's about whether the Howey test, a test designed for traditional securities, is flexible enough to deal with the nuances of digital assets. And that's a question that's going to have a ripple effect on the entire crypto world.
Yeah, it sounds like this isn't just about one company or one token. This case could set a major precedent for how digital assets are regulated going forward.
Absolutely. And it's not like the SEC is just picking on Ripple either. Stark's article points to their actions against Kraken and Coinbase as well.
Let's unpack those cases a bit, because it seems like the SEC is drawing a line in the sand here. What went down with Kraken and Coinbase, and how does that connect back to this idea of investor protection?
Well, it's like they're saying these crypto exchanges are operating like the Wild West, like they're above the law or something.
Trying to stay off the grid.
Right. The SEC is arguing that these exchanges are basically unregistered securities exchanges, letting people trade digital assets that should actually fall under their jurisdiction.
So it's like the SEC is the sheriff riding into town trying to bring some law and order to the crypto saloon.
Uh-huh. Exactly.
Yeah.
And in the Kraken case, at least the judge sided with the sheriff.
Hmm.
They agreed with the SEC, saying that, yeah, those digital currency transactions on Kraken's platform, those could be considered investment contracts, plain and
No.
simple.
Which goes against what Judge Torres ruled in the Ripple case, right?
Bingo. You got it.
Mm.
I remember she seemed to imply that just buying a token on an exchange somehow magically transformed it, even if it was originally sold as a potential investment, but the Kraken judge wasn't buying it.
So different courts, different interpretations. What about the Coinbase case? Where do they fit into this whole SEC crackdown?
Coinbase is an interesting one. They actually tried to get the SEC's case thrown out, said they
Yeah.
weren't doing anything wrong.
Bold move.
Right. But the judge disagreed, said the SEC had a legitimate case and allowed the lawsuit to move forward. So that's a pretty big deal because it directly challenges this idea that exchanges are somehow exempt from securities laws just because they're acting as this middleman.
Interesting. So the SEC is not just blowing smoke here. It sounds like they're racking up some wins. Does this mean the Ripple decision is on shaky ground? Legally speaking, of course.
Well, let's just say it definitely suggests that Judge Torres' interpretation might not be the winning hand. The fact that you have other judges looking at very similar cases and siding with the SEC, that's not a good sign for Ripple. But remember, nothing is set in stone yet. The Ripple appeal still has to be heard. The Second Circuit will make the final call.
Okay, so it's not over yet. Speaking of setting precedents, Stark also brings up those free stock cases from the 90s. Is there a parallel here to how Ripple distributed XRP? Could that end up hurting Judge Torres' reasoning?
Those free stock cases are definitely fascinating. And yeah, they might actually be the SEC's secret weapon. Remember how Judge Torres said those XRP giveaways to employees and partners? Those didn't count as investment contracts because there was no money exchanged.
Right, like they weren't really investing because they didn't open their wallets.
Exactly. But that's where those old cases come in.
Hmm.
The SEC actually went after companies who were giving away stock. Things like signing up for websites or handing over some personal information.
Wait, real?
Yeah. Their argument was even though there wasn't any cold, hard cash involved, these companies were still getting something valuable in return.
So it's like they were saying, sure, you didn't pay with dollars, but you paid with your data, your attention, your participation.
Exactly. And that, according to the SEC, still counts as consideration. It's a much broader interpretation of what actually makes an investment. It kind of undercuts Judge Torres' view that there needs to be this direct exchange of cash for an investment contract to even exist.
Okay, so those free stock cases definitely muddy the waters a bit. It seems like Judge Torres maybe overlooked a key precedent here. But if the SEC's argument is so strong, why do you think she ruled the way she did in the first place? What made the Ripple case so unique?
Yeah, that's the million-dollar question, isn't it? Honestly, some people think Judge Torres might have been trying to throw the crypto world a bone here.
Interesting. What do you mean?
Well, think about it. You have a judge here trying to apply a law written decades before Bitcoin even existed.
Right, trying to fit a square peg in a round hole.
Exactly. Maybe she saw a real difference between those early direct sales of XRP and the way it's traded on exchanges today. It's a totally new kind of market, and her ruling kind of acknowledged that.
So maybe she decided to trim the edges of that square peg a bit.
Yeah, something like that.
Yeah.
But here's the thing. Remember how Stark mentioned she specifically said her ruling shouldn't be taken as precedent?
Yeah, it's not every day you see a judge say, don't pay too much attention to what I decide here.
It's wild, right? Almost like she knew it would be appealed and maybe even overturned. So maybe she was trying to limit how much of an impact her ruling would have on other cases.
Wow, a pragmatic judge. Recognizing the limits of a law from a bygone era, it makes you wonder, if those shady 1920s stock offerings were happening today, would they even involve paper certificates? Wouldn't they be cooking up some kind of digital token?
It's a fascinating thought, isn't it? And it really highlights this challenge that regulators are facing. Technology just moves so fast, but the law is always trying to catch up.
Which brings us back to the core issue here, protecting investors. Because at the end of the day, a bad investment can still ruin you, right?
Absolutely. And that's what this whole debate comes down to. Can the SEC use laws written for traditional securities to regulate the Wild West of crypto? This Ripple case could have huge implications for the entire industry.
No doubt about it. Well, you've given us a lot to consider today. If you had to leave our listeners with just one big takeaway, the thing that keeps you up at night about all this, what would it be?
For me, it comes down to this. Should your level of financial knowledge, or even just knowing who you're buying from, should that really determine whether you deserve protection as an investor? At the end of the day, a rug pull is a rug pull, whether it's orchestrated through some fancy hedge fund or a digital wallet on your phone.
Couldn't have said it better myself.
Hmm.
We've really gone deep on the legal arguments, the precedents, the whole 9 yards. But we can't lose sight of the human cost of this whole debate, those everyday investors just trying to navigate this new world.
Absolutely. And this is a conversation that's far from over.
You got that right. Keep those thinking caps on, everyone. We'll be back soon with another deep dive.